Good morning, welcome to CATEX TV. My name is Frank Fortunato. Today is Wednesday, December 18th, 2013. In a surprise decision, a California state judge has ordered paint companies to pay $1.1 billion to 10 California cities and counties so that lead paint can be safely removed from millions of older homes. A Superior Court judge in Santa Clara County yesterday found Conagra Grocery Products, National Lead Industries, and Sherwin-Williams had marketed paint that they knew were harmful to children. The industry has faced multiple similar lawsuits across the country, but has won most of them. This verdict came after a 5-week trial without a jury. The companies have 15 days to appeal, which of course they will. The judge wrote in his opinion, this is a clear and present danger that needs to be addressed. The defendants sold lead paint with actual and constructive knowledge that it was harmful. A new report ranks the state of Florida as the most expensive state in the United States for home insurance. Obviously, this is a dubious distinction Florida is not interested in earning. The average premium for a typical homeowner's policy in Florida is $1,933. That's 4 times the cost of a policy in the state of Idaho, which is the lowest state for homeowners insurance. Of course, as we've reported before, Florida obviously is prone to hurricanes, which is the reason that the homeowners insurance rate is so high. But there have been no hurricanes of any significance in the past 3 or 4 years. As a result, the reinsurance premiums that reinsurers charge Florida insurance companies have dropped dramatically, and homeowners have petitioned the state for lower rates, and the state is looking favorably on this. Meanwhile, not to miss out, the London insurance and reinsurance market is planning to take on 10% more U.S. windstorm risk, i.e. Florida, adding to abundant capacity from both traditional and non-traditional sources that are already in Florida. One of the reasons the reinsurance rates in Florida have dropped, of course, is because of the insurance-linked securities market. Now, according to PricewaterhouseCoopers, the London market is interested in getting in because of the quiescent hurricane season and the high homeowners rates, which make for additional premium. Swiss Re came out with their annual report, which they do every year toward the end of the year. They said that natural and man-made catastrophes in 2013 have so far caused $130 billion in economic losses. These would be things tied to floods, hailstorms, and earthquakes. In 2012, it was $196 billion. Insured losses, however, fell from $81 billion down to $44 billion. That means that the floods and hurricanes and earthquakes have been striking areas that have light insurance penetration. They said that the costliest events, insurance-wise, were $18 billion in economic losses in Germany as a result of the flooding. There was $4.1 billion losses associated with that for insurance purposes in Germany. And Hailstorm Andreas in Germany and France had $3.4 billion in insured losses. 7,000 people were killed in the Philippines when Typhoon Haiyan struck there in November. The embattled U.S. insurer Tower Group said that it has repaid its bank loans using proceeds from the sale of its 10% stake in Lloyd's insurance company Canopius, but warned that it had been forced to absorb a further reserving charge of about $105 million. Canopius, of course, was just yesterday purchased by the Japanese insurance company Sampo. However, earlier, Tower had sold its stake, they couldn't wait for the sale, to a company called Briegel Capital. They sold it for $69.7 million, which preposterously was a discount from the $71.5 million that it paid for it in August 2012. Another negative decision for Tower Group. Meanwhile, in Washington, D.C. today, the Federal Reserve is meeting, and investors are waiting to see whether one of the outgoing chairman, Ben Bernanke's final acts will be to announce a pullback in the Federal Reserve bond purchase program. This goes under the name of so-called tapering. Undoubtedly that they will not end the program of buying the bond purchases immediately, but in fact will taper them off. The consensus is relatively split. However, most economists do not think that they will announce it today. However, an economist at Moody's said that it really feels like the economy has finally hit escape velocity. The economy is strong enough to propel growth and shrink unemployment without the Fed's extraordinary help. Mr. Bernanke will be succeeded later this week by Janet Yellen when the Senate approves her nomination. Well, there's been a deal reached in Moscow between Ukraine and Russia. A so-called, quote, historic agreement between the two countries has allowed Ukraine to avoid bankruptcy and social collapse. The deal will involve Moscow buying about $15 billion of Ukrainian bonds, as well as cutting natural gas prices by about 33%. They sell natural gas to the Ukraine. The agreement came amidst continuing protests in Kiev from protesters who were outraged that the Ukraine government decided not to proceed with the agreement to go ahead and join the European Union. The Ukraine government said that they could not have agreed to the European Union agreement because that would have imposed unfeasibly stringent International Monetary Fund conditions on economic reform. God forbid they reform the economy. Meanwhile, Russian President Vladimir Putin said that the deal announced in Moscow today was to help the Ukraine through its problems, as a big debt repayment is looming, and the Russians will take care of that. They also said that there had been no discussion whatever on Kiev joining a Russia-led customs union, something similar to a baby building to the European Union. President Putin said, "I want to calm you all down. We have not discussed the issue of Ukraine's joining the customs union at all today." Well, when Vladimir Putin says he wants to calm you down, you better listen. That's the news for today. If we have any breaking news, we'll come back and tell you. Thank you for watching, and we'll see you tomorrow.